You know that old saying, make hay while the sun shines. That's exactly what we should be thinking about right now, because the sun is definitely shining for small business owners. The Big Beautiful Tax Bill makes one of the biggest small business tax breaks, which is the qualified deduction, the qualified business income deduction, or QBI. They make it permanent. And when I say permanent, I mean it. No more sunset, no more waiting for Congress to extend it. It's locked in for tax year, beginning after December 31st, 2025. So if you run a business, especially if you file Schedule C or you have an S-Corp, that is your chance to plan long-term and use the deduction to your advantage. Make hay while the sun shines. That's our theme today, because the best time to plan smart tax strategy is when the rules are stable. And right now, they finally are. Let's start with the basics. Before this law, the QBI deduction was supposed to disappear after 2025. So people rushed to claim it while they could. Now, under the Big Beautiful Tax Bill, you can deduct up to 20% of your qualified business income every single year permanently. So this is a big deal. So if your business makes $100K in profit, you could potentially shave off 20 grand of your taxable income without spending another dime. So this is like taking a billing tax coupon for being self-employed. Now let's talk about where the real planning starts. So talk about your business structure. So if you are still a sole proprietor filing Schedule C, that's perfectly fine when you're starting out. But once your profits start to grow, say you are making about 100K or more, an S-Corp might give you more flexibility. That's why when you operate as an S-Corp, you are both an owner and an employee. So you pay yourself a reasonable wage for the work you do, and whatever left over after that becomes profit, which passes through to you as shareholder. And that's where the QBI deduction comes in. It applies to that business profit portion, not the wages. So let's play this out with some numbers. So let's say your S-Corp earned 100K in total business profit before paying you. You decide to pay yourself 50K in W-2 wages, and that leaves another 50K as profit. So you will pay regular payroll taxes on the 50K wages, but the other 50K of profit, that part is eligible for the 20% QBI deduction. So 20% of 50K is 10 grand. So that 10 grand deduction just for structuring your income correctly. Now, here's the key question everyone asks. Would it be better to pay yourself more wages or less wages? So let's think it through. So if you pay yourself more wages, say 70K instead of 50K, so that leaves only 30 grand in profit. So your QBI deduction would then drop to become 20% of 30 grand or 6 grand. So you will get a smaller QBI deduction. But, and this is important, if you pay yourself too little wages, the IRS might challenge whether that pay is reasonable. If they think you are underpaying yourself just to juice your QBI deduction, they can reclassify part of your profit as wages and add back payroll taxes. So the goal is balance. So enough wages to pass the reasonable compensation test, but not so much that you eat into your QBI deduction. In most service-based business, that reasonable range often falls somewhere between 40 to 60% of total profit. Although it depends on your industry and how involved you are in business. If you are doing all the work yourself, wages might need to be higher. If you got staff or a contractor doing most of the heavy lifting, your own wages could be lower. So in that 100K example, paying yourself 50 grand in wages and taking 50 grand in profit usually strike in good balance. That's give you 100 grand in QBI deduction and keep your payroll taxes reasonable. And here's another bonus. the wages you pay yourself can actually help you qualify for a QBI deduction in higher income scenarios, because there's a rule that limit the deduction based on W-2 wages paid. So wages hurt you a little on one side but help you on the other. So it's like a teeter-totter. You just want to find the level spot. Make hay while the sun shines, and this is where it shines brightest, when you keep being proactive with your planning. Now, not everybody's business get the full QBI benefit. Some professions like doctors, lawyers, accountants, consultants, and financial advisors are considered specific service trade or businesses. So basically, if your business depends mostly on your personal skill or reputation, there's a limit on how much income qualifies for deduction. The higher your income, the smaller the QBI deduction becomes until it disappears completely. But the big beautiful tax bill gave the service business some good news too. So they'll face our limit are now higher, and they will rise automatically with inflation each year. That means more consultants, freelancers, and professional specialists can still qualify even as their income grows. So if you are in one of those professions, the name of the game is income management. Let's say you are a consultant making 350 grand. Before this new law, you probably lost most or half of your QBI deduction because you were over the limit. But under the new inflation index threshold, you might still qualify for part of it. And that's where tax plan really shine. You could contribute more to a retirement plan. You can prepay some business expenses before the year end, or delay invoicing a client until January, just to bring your taxable income under that line. None of those moves cost you a thing. You are just timing them smartly. That's how you make the most of this deduction, even in a skill-based business. Now let's talk about another level, retirement contributions. So this is one of my favorite tools because it kills two birds with one stone. When you keep put money into a solo 401k or a SEP IRA, you reduce both your taxable income and your QBI. At first, that sounds bad, right? So why lower the income? So that's where the 20% apply to. Because if your income is high enough to start phasing out the deduction, lowering it actually brings the deduction back. So you are giving up a small slice of QBI, but you are keeping the full 20% of what's left. For example, if you make 200 grand and put 20 grand in your solo 401k, your new taxable income is 180k, and that could be the difference between getting a full QBI deduction or a partial one. That's why year-end planning is so important. Don't wait until April to decide how much you contribute. You want to run those numbers in November or December while you still have time to adjust. Now, equipment and assets, another area with big opportunities. Under the big beautiful tax bill, you can still use Section 179 expensing and bonus depreciation to deduct the full cost of qualifying purchases in the year you build them. Let's say you own a small landscaping business and you need a new truck or mower. Buying it this year might lower your income enough to keep you under the QBI limit. That could save you twice, once from the deduction on the truck and again from keeping your QBI intact. But be careful. Go too far and you shrink the QBI base too much. This isn't about buying everything in sight. It's about spreading your purchases smartly across years to smooth out your taxable income. Think of it as pacing yourself, not sprinting. Make haste while the sun shines, but don't exhaust the whole field in one season. And of course, bookkeeping, the quiet hero in all of this. So your QBI deduction depends on your net profit, which comes straight from your books. If your expenses are sloppy or miscategorized, your deduction calculation will be up. So clean books mean accurate deductions. That's why even the best tax plans start with organized records. If you don't already use accounting software, this is the time to start. Connect your business account, track your expenses, and track your report every month. That's not easy work. That's the backbone of smart tax planning. So let's bring it all home. So QBI is now permanent and not going anywhere. And that means your tax planning can finally shift from reactive to proactive. You can now choose your business structure with confidence. You can plan your wages and profit intentionally. You can use retirement and equipment deduction strategically. And if you are in a service field, you can manage your income timing to stay eligible. It's all about long-term positioning. Make hay while the sun shines. The conditions are right, the rules are steady, and the opportunity is real. Don't just claim the deduction, plan around it, because the businesses that plan ahead are the ones that thrive the longest. Thank you for watching. I'm Mia. I will see you at the next video.